What do we think the Bitcoin price is going to be in about 2 years' time at the next halving in 2028? This is going to be the focus of today's video. So to understand how we can project into the future is unknown, so how can we do it? We could squiggle on the charts, we could look at all different weird and wonderful indicators, or we can go to the raw physics of what happens in the network at particular moments in time in a schedule set by Satoshi himself, the halving event. And to do so, we're going to look at the price. That's what we're trying to project. We're looking at that cost to produce from the Bitcoin miners, their energy to Bitcoin exchange rate. And that allows us to create a projection of what we think the price is going to be in 2 years. So 2 years ago, April 2024, the cost to produce creeped from 23,000 and doubled essentially to 52,000 as an average. Now, why did that happen? At the same time, price creeped up beforehand and leveled out at that same cost to produce and creeped up above it. And this is because price is a financial fiat fatty premium on top of the cost to produce. And that's the margin that miners earn as a network average. And so you can see that around the halving, where miners take a 50% pay cut, they're not performing well. And the dream of all miners is for their cost to stay low and the price of what they're earning to go up. And that is a bull cycle. And that bull cycle is price going up and charting new territory and the miners earning that margin between. And as we know of the last few months, price has been dropping and dropping and dropping. People trying to understand where the price is going to go. But here's what we do know, that there is a cost to produce in energy for Bitcoin. People with millions and billions of dollars worth of infrastructure and computer chips all connected to different systems and services around the planet. That's a lot of money. That's a lot of setup. There's a lot of cost. So if you are able to buy something financially on an exchange at the click of a button at roughly the same price that people deploying infrastructure and taking far more risk than you've got a good price. And the analogy for that is if you can buy the tomatoes at the same price that the farmer grows them, you have the best price. And so these bits of information allow you to model what the value of Bitcoin is in energy terms, in a world full of all things that cost energy, time, and moving it through space. Well, you can compare that to this fiat delusion we call price. And that projection of the halving, which quite simply boils down to this. You're mining Bitcoin, you have an energy bill, and TikTok next block cuts what you are earning in half. So what happens is the halving to miners is essentially the doubling. So their cost to produce doubles because the amount that they earn cuts in half while the energy bill stays the same. So you now need twice as much energy for that same amount of Bitcoin. Or in dollar terms, the cost to produce doubling, as shown here with the faded pen. So what I'm trying to get at here is that what we absolutely do know in 2 years' time, roughly, is the cost to produce right now would double to 106,000. That's not factoring in that what is the difficulty going to do over the next 2 years? There is a confidence that it's going to keep going up because there's still these economic opportunities for miners to plug into all different things, driving that cost to produce up. But even if it stayed at about 60,000 and the halving comes along, it means that this new blue line is going to be up here in 2 years' time to the 100+ range. So what I'm trying to get at is to say that if we're confident that price is going to stay above production, as it always does, the cost to produce a Bitcoin in 2 years is going to be $120,000+. So the price, we can confidently project, price is going to be more than 120,000, which is double today. So the key statement for this video is to say, can you outperform a 2x in 2 years? If you can't, just hold Bitcoin. And the price right now is close to production. So whether you are buying Bitcoin thinking this is a good price, or you are looking at the idea of mining, which is also a good period of time, which sounds crazy to say because profitability is nominal to none, but that's the exact paradox that people get tripped up by with mining. At the peak of the bull market, the returns that you can get from mining on paper look amazing. So you buy miners at crazy expensive premiums and then get absolutely flushed by the reality check of buying at the wrong time. The paradox to that is when the machines that you want to produce Bitcoin with, when the numbers look extremely terrible, that is the exact moment to be buying the machines. But the economics of mining have changed, and I'll delve into another video with this, which is to say that you've got to produce the power more than pay for it from someone else. And that changes things up quite interestingly. But yeah, I'll leave it for this video, which is to say that we think the cost to produce could creep confidently to 60,000. A more expected bullish outcome is that creeps to $80,000 to $100,000 to produce by the halving, which cuts that in half again, so the cost to produce could jump to 200,000 and the price would sit at maybe 220, 250,000, which is multiples of the price of today. At the same time, the US is looking to print obnoxious amounts of dollars, seeking scarce things to preserve that time and energy. And so, yeah, I have no worry about the dollar price of Bitcoin. I just think it's trying to shake anything and everyone out of the market, especially everyone that's been taking out loans up here without thinking to keep your LTV below cost to produce. Because if you keep your LTV for loans below the cost to produce, you are within a safety margin that the network itself can defend you. Yeah, that'll be it for this video. Thank you for listening. I hope you enjoyed, and I'll see you in the next video. Goodbye.